Doug, let's talk about the economy, then we'll talk about investing. What are your thoughts on the labor market right now?
I think it's really weak, and unfortunately, it looks like it's getting weaker. We have had a hiring freeze for the last 8 months. From May through December, on net, employers only generated 96,000 new jobs. That's not nearly enough to support consumption growth at a level that stock investors want.
And I thought that the American economy is based on consumption. More than half of it is based on consumption. So can you dig a little bit deeper and talk about what this means when you have this lack of hiring and a hiring freeze? What does that mean for consumption?
Well, it means that disposable income, after-tax income, is growing at a crawl. And if that's the case, households either have to dip into their savings or they have to borrow to be able to keep consumption growing at that rate that keeps earnings growing, again, like bond investors and equity investors want. They haven't borrowed in this cycle. So it's really putting a whole lot of pressure on reducing the savings rate. Households cut the savings rate by 2 full percentage points, from 5.5% in April to 3.5% in November. There's very, very little scope for that to continue. So if hiring doesn't pick up, we expect there's going to be pressure on consumption.
But are rich people still spending? Because we've been hearing about a K-shaped economy where the rich keep spending and the poor not as much.
It does appear that the rich have been spending and that to some degree they've sort of been bridging the gap while the hoi polloi doesn't have the income to support consumption. But I don't think that is really sustainable. In my view, the lower leg of the K-shaped economy that describes the bifurcation between households, I believe the lower leg of the K is more important, and that has started to draw in more and more of the middle class and even the upper middle class.
And how does AI play into this? Because from what I hear, it's not going to be good for job creation. In fact, it's probably going to shave off a lot of jobs. But on the other hand, it's going to make companies a whole lot more profitable.
So it sort of gets to what Henry Ford discovered, that he felt like he needed to pay his workers enough to be able to buy Model A's and Model T's. There was no such thing as the term addressable market back then, but I think he figured it out. And the key is that, look, my spending is your income, your spending is my income. That gets reiterated over and over throughout the economy, so that if we have really weak employment growth, if we have jobs or wages not growing the way we want them to, eventually that drags on companies' top line, drags on their sales. So even though in the near term, if you get more efficient and profit margins go up, that's good for profits. But beyond a couple of quarters, if people start spending less, that hits the revenue line, and that's going to make the bottom line even worse.
And what are your thoughts on inflation? I know the Fed has their target at 2%, but it seems like they've given up on their target. And right now they seem pleased with 2.7%.
You know, I think that this is all going to work out for the Fed, that maybe we'll get to that 2% target by the end of the year. We know that shelter is 40-some% of core CPI. It's about a third of core PCE, and that's coming down. There are tons of multifamily units, apartment units still in the pipeline. So we know that there's downward pressure on rents. That's going to take core inflation measures down. And additionally, as the tariffs wash through, assuming we don't need to apply more to take over Greenland, then goods inflation, we actually expect goods prices, they're going to deflate. It's not just that inflation's going to decelerate, it's that we expect they'll begin falling again, so that there are a lot of tailwinds for inflation to come down. And we really don't think the Fed has to be worried about inflation at this point.
Okay, finally, let's put it all together. What should investors be doing under this economic scenario that you just described?
So look, as I described, we have plenty of qualms about the fundamental backdrop for the economy and for corporate earnings. However, I'm not about to stick my head in front of the train that is the AI narrative. So what I think investors should do is remain at least equal weight equities, but with an eye on the exit door if we continue to see hiring completely stagnate, and if that, which we think is inevitable, starts pulling down consumption growth, then begin to make a plan for the exits. But you don't want to do it prematurely, because at the end of really concentrated, powerfully narrative-driven bull markets, stocks tend to explode higher at the finish, and you don't want to be on the wrong side of that.
All right, well, thanks for coming on and talking about it.
Thank you, Greg.